In this video, we are going to talk about why did the crypto market crash. So before starting, please like this video and subscribe to this channel for our future updates. The beginning of the year has not been kind to cryptocurrencies in general. Despite a late rally, Bitcoin, BTC, had lost more than 20% of its value since the beginning of the year as of January 26. During that time, the prices of Ethereum, ETH, and Binance Coin, BNB, fell by approximately 30% and 25%, respectively. Not counting the stable coin known as Tether, USDT, which is pegged to the value of the United States dollar, these are the three most valuable cryptocurrencies currently in circulation according to their market capitalization. This is not the first time that crypto has experienced a significant decline in value. Bitcoin's value fell by more than 45% between the middle of May and the middle of July 2021, when the market experienced another major slump. Many investors are still interested in cryptocurrencies, despite the volatility that they experience. Early investing Sven Narayanan, Vice President of Strategy, believes that as cryptocurrency acceptance grows, it will become more stable. He also believes that until then, however, investors might want to know what red flags to look out for so that they can avoid losing money in a cryptocurrency market meltdown. Why are crypto markets falling? Bitcoin has traded below $30,000 for the first time since July 2021, and it is down nearly 56% from its peak in November of last year. These are some of the remarks that Shivam Thakral, CEO of BayuCoin, made to Business Today regarding the crash of the cryptocurrency markets. He then went on to list the reasons for the meltdown, saying, "The global financial markets are being pounded by rising inflation, mounting tension between Russia and Ukraine, and a highly dangerous scenario in Sri Lanka." The Indian rupee reached a new all-time low during the trading session, which is likely to make the country's imports more expensive and will have a substantial effect on the country's financial markets. The problems we've already talked about are also putting a lot of pressure on the cryptocurrency market. As a result, investors are selling off a lot of their holdings to park the cash for better times. Here are 6 reasons why cryptocurrencies have experienced a decline in value. Number 6. Cryptocurrency correlations with the stock market. The potential for cryptocurrency to be an uncorrelated asset is one of its many attractive features. In other words, it ought to be untethered from the rest of the market and allowed to float freely. On the other hand, this is not always the case. As a result of increased traditional acceptance over the course of the previous few years, crypto markets have become more linked with traditional markets. According to Peters, in the opinion of certain individuals, there is a strong connection between cryptocurrency and the stock market. So, the world's newest hedge against rising interest rates and inflation might actually be more associated with the general stock market than early adopters had anticipated. However, as Narayanan points out, crypto collapses are an inevitable element of investing in cryptocurrency. The most important questions for investors to answer are related to the length of time they plan to keep their digital assets and their capacity to withstand market volatility. Number 5. Crypto influencers causing volatility. Investors in cryptocurrencies need to keep in mind that, according to Peters, crypto enthusiasts and major influencers can tweet and induce an inflow of capital. This is important to keep in mind in terms of mood. It is abundantly clear that we have witnessed this take place with Elon Musk's sponsorship of Dogecoin. Tweeting has the potential to have the reverse of the intended effect. This is due to the fact that the value of this asset class is based on the sentiment of investors as well as the lack of liquidity in the cryptocurrency market. Stablecoins present an opportunity for investors as a potential solution to this issue. Because of the ease with which this sort of coin can be traded, traders can easily enter and exit other cryptocurrency positions as the market shifts. Number 4. Crypto security breaches causing fear. According to Peters, blockchain technology and network security are 2 other elements that could cause a crash in the cryptocurrency market. A crash of this nature would play out in a manner not dissimilar to how regulatory disruptions caused by government actors do. For instance, if it were discovered that Bitcoin contained a security hole, this would reduce the incentive to mine Bitcoin, which in turn might have repercussions for both the hash rate and the price as a whole. According to Narayanan, this is a brand new asset class. It has been estimated that there will never be more than a certain number of bitcoins in circulation. And in contrast to stocks, the value of most cryptocurrencies is driven almost entirely by the sentiment of investors. Stocks, on the other hand, are underpinned by real assets. According to Dan Kemp, Global Chief Investment Officer at Morningstar Investment Management, the challenge for investors who wish to hold cryptocurrency is to find those that have limited supply and enduring appeal. The challenge for investors who want to hold cryptocurrency is to find ones with a limited supply and lasting appeal. Number 3. Cryptocurrency regulation. Miners had no choice but to relocate to other jurisdictions that were more miner-friendly when China issued its ban on cryptocurrency mining in June of 2021, adds Peters. The news that we witnessed a large reduction in the network hash rate had serious repercussions for investors in cryptocurrencies. In the realm of cryptography, the number of computations that may be carried out in 1 second is referred to as a hash rate. The outcome of these computations determines the price of a currency and is what enables miners to produce the coins they are mining in the first place. The hash rate goes down whenever the price of Bitcoin goes down. It has been hypothesized that the converse is also true in some circumstances. This is typically due to the fact that miners are compensated in cryptocurrency. On the other hand, this also suggests that the general price of cryptocurrencies may go down if governments implement rules that make mining more difficult. Number 2. Lack of liquidity in cryptocurrency markets. When leveraged investors sell off a significant portion of their holdings, the most significant challenge for the cryptocurrency markets is the general reduction in the amount of liquid assets available on the market. In contrast to the stock market, there are not always a large number of buyers waiting in line to purchase coins that have been unloaded. Crashing in the cryptocurrency market is more likely to take place on weekends for this reason, among other reasons. When a large quantity of coins is sold, there are fewer investors tuned in to make purchases. Narayanan says, this is the reason why large institutions are unable to trade in low-value coins. They ultimately cause disruptions in the market. For instance, a whale is a type of investor who maintains a substantial stake in a certain asset, and when a whale sells significant sums of cryptocurrency, it has the potential to flood the market. The coins are then sold on the secondary market, where there is a surplus of supply but only a limited demand for them. Number 1. Crypto investors taking on too much leverage. The BTC leverage ratio of cryptocurrency data firm CryptoQuant reached all-time highs in early January, indicating that more investors are taking on risk in the cryptocurrency industry. To finance their purchases of futures contracts, crypto investors frequently rely on loans, just as they do in traditional markets. Miners have the option of using this strategy to protect themselves from any price declines in the cryptocurrencies they mine. eToro Senior Account Manager Simon Peters believes that the high levels of leverage in the cryptocurrency market may spell instability in the near term for the asset class. According to Peters, price drops could prompt liquidation of long-term positions, and this is true across all asset classes. When prices begin to fall and futures holders begin to liquidate their bets, the price of commodities may fall even further. It is a cycle that is comparable to what took place in the stock market in 1929 and in 2008. However, crashes of this nature are especially hazardous for markets that don't have a lot of liquidity, such as the cryptocurrency market. What do you think about our video? Please let us know in the comments area below. If you enjoyed this video and would want to hear from me again, please subscribe and turn on the notification before leaving. Thank you for watching us.